Canada's annual inflation rate has dropped to its lowest in 3 years, and for many market players, that paves the way for a third consecutive rate cut by the Bank of Canada in September. Our guest believes the risk of a recession in this country is very high. We are joined by Vinayak Seshasayee, Portfolio Manager at PIMCO. Thanks very much for coming on the show.
Thanks for having me on.
Comparing the US and Canadian economies, we're in worse shape right now in Canada, you think?
That is what we believe, yes. I mean, if you look at the labor markets and the growth in the two countries, Canada has been running significantly slower than the US over the past 18 months or so. I noticed you talked about the US unemployment rate with your previous guest. If you look at Canada, the unemployment rate's risen 1.6 percentage points since its lows in early 2023. So that would put us in a significantly vulnerable position. And at the same time, growth's been running very slow. So we do think risks of recession are very high.
Do you think the Bank of Canada will maybe have to go for even 50 basis point cuts?
It's not our base case. We do expect right now for them to continue at their 25 basis point pace over the coming several meetings. But it's certainly a risk, and it's something we can't rule out, particularly if the unemployment rate were to rise more, maybe closer to 7%. I think it would create a sense of urgency in supporting the expansion and supporting the economy.
We've heard repeatedly that our relatively high level of debt in Canada, household debt, for example, makes us particularly sensitive to interest rates. So this will provide a boost, this reduction in borrowing costs.
It will, but the boost won't really be as big as people think it will be, because while it will, help certain companies and people that have variable rate mortgages, what we mustn't forget is that there's still a lot of people who are paying fixed rates on mortgages that were incepted around the time of COVID that are very low rates. So even if the Bank of Canada were to cut rates down to, say, 3% or so, you'd still see a lot of people having to make higher mortgage payments over the next 18 months. And then that's one of the things that makes Canada very different from US in this regard. And we are very levered to interest rates. And so if our economy were to deteriorate more significantly, interest rates is the primary lever of supporting that.
I remember my mortgage broker saying, "Bell, take this fixed rate. It's really attractive." And I was glad I listened to him because we got a really competitive loan. Yeah,
absolutely.
Yeah. What about the Fed for their part? Obviously, the old cliche, we're just a carbuncle on the US economy. If the Fed holds off from cuts, what does that mean for Canada?
I think that does impact the BoC's calculus a little bit. But not by much, we think. Well, first and foremost, actually, it does seem like the Fed is also gearing up to remove some amount of restrictiveness in their economy. And we actually do expect the Fed to cut at each of the next 3 meetings. So the BoC won't be on their own. But even if the Fed were to hold for some reason, we do think, the Bank of Canada's primary goal is to, focus on inflation in the Canadian economy. And one of the things that they've mentioned more recently is that they're more attuned to downside risks. So over a long period of time, they need to make sure inflation is at 2%, but not below. So those downside risks have become more, I would say, evident in recent times as the economy has weakened. So I still think that they will continue to be guided by their mandate, which is the Canadian economy.
I suppose there's always a risk. Consumers and businesses decide, well, I'm not going to buy stuff. It's going to be cheaper down the road. Everybody's hurting.
We're certainly seeing that with the housing market. We've seen a lot of people at current levels hold off on purchases. And there's, if you look at certain markets such as Toronto and Vancouver, there's certainly a lot of supply of housing that's not yet clearing, with people waiting for lower interest rates.
You are bearish on the Canadian dollar, essentially.
We are mildly bearish on the Canadian dollar, and that does have to do with the fact that we think the BoC will have to be more aggressive than the Fed in lowering policy rates.
How do you have we've got a Canadian dollar. It's been pretty stable, given that we started cutting rates before the Americans. What would your downside target be for the Canadian dollar, if you have one?
I think we see it weakening, but we don't see it weakening significantly through 140. So I wouldn't say the downside would be 140, only about 4% from here, or 3%.
3 or 4% down from here. And actually, I forgot to ask you that you touched on the fact that a lot of mortgages have still to come up for renewal at much higher rates. So you don't necessarily see this reduction in borrowing costs as sparking a housing boom in Canada.
No, if anything, we only see it as preventing house prices from falling further and stabilizing the market.
That's, yeah. What, you're recommending long-term bonds right now in Canada. You think they look decent?
Yeah, I mean, what we really think makes a lot of sense, at least within the fixed income landscape, is to look, for the past year or so, cash has been a very attractive place to invest, 5% yield, nothing wrong with that. But as the Bank of Canada has begun their rate cutting cycle, and we do think that that will pick up steam, we think the attractiveness of cash will continue to diminish. While investing into longer term bonds, I mean, this is the time to get out of cash and go into longer term bonds where you're picking up more yield. You're locking that yield in for several years, whereas cash, your yields disappear as soon as rate cuts come. And then most importantly, with inflation less of a concern, we do think bonds will once again be a diversifier to equities. So I think that's a pretty attractive valuation right there.